Hello everyone, and I welcome you to my video in which I will explain to you the accounting of cryptocurrencies within the US GAAP, and I will refer to the guidance published by the American Institute for CPAs and CIMA in order to address concerns here. My name is Mustafa and I have published a master thesis regarding the accounting of crypto assets in different accounting standards like IFRS, US GAAP, and Swiss Code of Obligations and Swiss GAAP FAIR. Therefore, I have researched the relevant information and knowledge that I can share with you. So I urge you to be tuned for new videos to understand the accounting of crypto assets in different regions. As you may know or you don't, I will always start and end my lectures with an essential quote. I start this video with Theodore Roosevelt quote. He was the 26th President of the United States. He remains also to be one of the youngest person to become the President of the United States at the age of 42. Anyway, Roosevelt said, "Do what you can with what you have where you are." This is exactly the point here. No accounting association or standard setting body like US GAAP or FASB included crypto or digital assets when they framed the accounting rules and principles of organizations and individuals. However, this does not stop companies and corporations or even individuals who are living in the US to invest in crypto assets. In fact, despite the substantial interest of corporations, there is no accounting standard by related government agencies, accounting standard setting body, or even industry groups. US GAAP or the FASB does not offer specific guidance for the treatment of digital assets, and to date, the Financial Accounting Standards Board, the FASB, has not decided to add a project on accounting for cryptocurrencies. It is not yet in their agenda. Hence, companies rely on guidance, especially that is being published by experts in the market, to address concerns such as regulatory uncertainty, financial reporting, and legal compliance. This is where the IACPA and the CIMA became the leader in the crypto guidance for corporations that are operating in the US. So, to obtain further accounting guidance for US corporation, CIMA and American Institute for CPA, they stood up together and they have authored a white paper, that's what they called, to publish non-authoritative accounting guidance. So it's non-authoritative. It doesn't have to be followed by all companies that are operating in the US. It is their option to choose to actually rely on this accounting guidance or not, because it is non-authoritative. So they prepare this guidance adhering to the rules and principles of the US GAAP. And who are they? American Institute of CPAs and the Chartered Institute of Management Accountants. Together, they empower the world's most highly skilled accountants, so as we know as CPAs or CGMA designation holders. And they provide them with the knowledge, insight, and foresight to meet today's demands and tomorrow's challenges. So, for example, crypto assets. Okay, so the white paper, it targets corporations and auditors operating in the DLT industry located in the US. The Financial Reporting Executive Committee, as we know as FINREC, and the Assurance Services Executive Committee, ASEC, they represent the working group of this white paper that is being published by ICPA and and CIMA. So yes, these accounting subgroups, they have provided non-authoritative accounting guidance for corporations that are operating with digital assets and they want to include them in their financial reporting. They prepare this guidance by referring to the GAAP and the FASB rules. So the working groups, they have identified the necessary functions to recognize a digital assets. First of all, the medium of exchange to offer goods or services is one function. Second, a digital asset is not developed by a jurisdictional authority, not a security, and does not constitute contractual rights between the holder and another individual. So the accounting subgroup, they prepared a guidance based on the characteristics of Bitcoin and Ethereum. So cryptocurrencies and payment tokens. However, they did not refer to the other types of crypto assets such as stable coins, CBDC, security tokens, utility tokens, or even NFTs, because they have different characteristics, rights, obligations that are completely different to Bitcoin and Ethereum and cryptocurrencies in general. So the accounting subgroup has decided that digital assets will not meet the characteristics of cash or even cash equivalents because they are not considered as legal tender under US GAAP. In addition, since national banks and governments did not develop the digital assets or the cryptocurrencies, the subgroup, they have said that they will not recognize digital currencies as cash or cash equivalents. However, jurisdictional authorities are planning to develop CBDCs that can allow holders to actually recognize this CBDC as cash equivalents under the definition of the US GAAP for cash. So in the future, I believe that this accounting treatment will change depending on the type of digital asset that is being held or issued by the company. Nevertheless, the accounting subgroup did not recognize digital assets as financial instruments or even financial assets, adhering to the FASB ASC Master Glossary definitions. For example, since Bitcoins do not give rise to contractual rights to receive cash or financial instrument, companies cannot recognize Bitcoins as financial instruments or financial assets. However, I also refer again that the accounting subgroup did not refer to the characteristics of other digital assets that can actually implement or reveal contractual rights to receive cash or any type of financial asset at a certain point of time. Pursuant to the FASB ASC Master Glossary, digital assets also do not comply with the definition of inventory. And please note, inventory is allowed under the IFRS guidance. However, here, the accounting subgroup has decided not to recognize the digital assets as tangible assets or inventory, although some entities in the US may actually sell these digital assets in their ordinary course of business. Therefore, the subgroup has developed results that actually contradict the agenda decision of the IFRS back in June 2019. Since the guidance of the American Institute for CPAs and CIMA are non-authoritative, I come back again, they are non-authoritative. That means that US entities, actually, they will face challenges in recognizing, measuring, presenting, and disclosing digital assets in their financial statements. Okay, now we go to the one accounting treatment that is actually allowed under this white paper guidance. So the subgroup, they have concluded that the characteristics of digital assets comply with the definition of intangible assets under the FASB ASC 350, intangibles, goodwill, and other. Since cryptocurrencies do not impose an inherent limit on the useful life, the accounting subgroup has classified digital currencies as intangible assets with indefinite useful life. However, the IFRS, in their agenda decision, they have not specified the useful life of cryptocurrencies recognized as intangibles or inventory. Here, under this white paper guidance, they said it is intangible with indefinite useful life. So, indefinite lived intangible assets are initially measured at a cost and are not subject to amortization because they are indefinite. However, entities still need to apply an impairment test annually or more frequently if the events and circumstances indicate a change in the value of indefinite-lived digital assets. And this is obviously something that we see in digital currencies or cryptocurrencies. As we know, in the DLT, cryptocurrencies are highly volatile. Therefore, companies actually need to consider the consistent valuation of digital assets. In addition, DLT firms shall recognize an impairment loss if the carrying amount of the digital assets exceeds the fair value of a principal market. That means that when the asset is impaired, the company must write down the value on its books. However, the converse of this statement is not true, which means that the value of an asset cannot actually be written up when or even if the price goes up or a previously written down asset subsequently recovers. And we know that this is exactly happening in Bitcoin. At a year it could be 30,000, and another year it could be 60, and then it go back to 30, and then it could go back to 60. So this is an issue that will be facing US corporations recognizing digital assets as intangible assets with indefinite useful life. The working groups, they have also defined a principal market. They said that is a market with high transaction volume for the asset or liability. However, companies issue new tokens that may not be traded with high transaction volume. It may be challenging for these firms to actually determine a principal market for their digital assets. However, companies could use their broker or exchange market as a principal market as long as, and that's what they refer to, that they interact with these markets or with these brokers to regularly buy and sell digital assets. The white paper also mentioned that if a company has obtained sufficient evidence that another broker or crypto exchange market has a greater volume or level of activity, in that case, this company should then consider this broker or exchange market as the principal market. So what we can deduce or know for sure from this white paper is that the accounting subgroup has provided accounting guidance based on the characteristics of Bitcoin and Ethereum. However, they have not considered or actually specified the impact of implying or applying other types of digital assets in the financial statements, like CBDC, security, NFTs, how we can apply these assets in our financial statements, how we can record them. That was not mentioned by the white paper guidance. Nevertheless, they have not addressed the financial statement challenges. They did not provide interpretations for US corporations holding digital assets other than Bitcoin or Ethereum. And the lack of actually having a regulated accounting standard under US GAAP or FASB, this actually challenges US corporations in classifying digital assets, under the US GAAP. Okay, so now I come to my motivational quote to conclude this lecture or video. If opportunity doesn't knock, build a door. And it was said by Milton Berle, one of the most famous comedians and actors. This is exactly what the CIMA and American Institute of CPA is doing by meeting together with several board members to issue reporting solutions for companies operating in the DLT. However, I believe the US Fed and US GAAP and FASB, they all have a work plan for the next years to start deliberations and collect feedback from experts, accounting associations, and actually accounting organization before they execute guidance or maybe even issue a completely new standard for crypto assets or liabilities. US corporations and individuals are highly involved in crypto assets and the DLT. Therefore, the US government, they should take further steps to legalize the operations within the DLT. We know now for sure that famous US celebrities are all buying NFTs as a part of their social and economic status, like Eminem and Snoop Dogg. So I guess it is really important for the US Senate to actually take steps in order to help companies implement reporting solutions for digital assets. So thank you for listening, and please subscribe to my channel to be tuned for new topics. See you soon. Goodbye.